All right, welcome Talk Tickers. So Similarweb just dropped its Q3 earnings, and wow, what a disconnect. You had management on the call sounding pretty optimistic, but the market's reaction was, well, the complete opposite. The stock took a nosedive. So today, we're going to break down exactly what went on, what spooked investors, and what this all means for the stock from here.
Okay, so here's how we're going to tackle this. First, we'll hit the big numbers, the good and the bad. Then we'll dig into the story management is telling. After that, we'll look at why the market wasn't buying it. And finally, we'll wrap it all up with our own rating and what to watch for next.
All right, first up, the earnings snapshot. And really, this quarter was a classic tale of two numbers. It's like you had this great news on one side and then some not so great news on the other. And that tension is exactly what triggered the big sell-off.
So let's start with the good stuff. On the bottom line, the company showed some really impressive discipline. They delivered a non-GAAP profit of 5 cents a share. Now, Wall Street was only expecting 2 cents, so they more than doubled it. That's a huge beat, and a clear sign they're really focused on running the business efficiently.
But then you look at the top line, and it's a completely different story. Revenue landed at $71.8 million. I mean, look, that's still up 11% from last year, which isn't terrible. But, and this is the big but, it was a miss. It was just shy of expectations. And in this market, even a slight miss on revenue gets absolutely punished.
And yeah, the market's verdict was swift, and it was brutal. That profit beat? It's like nobody cared. All eyes were on that revenue miss, and investors just hammered the sell button. The stock plunged almost 8% on way heavier than usual trading volume. Ouch!
So what did management have to say about all this? Well, on their earnings call, they came out swinging with a really confident bull case. Their story was basically, hey, we're executing with discipline, and we're staring down a massive opportunity with generative AI.
You know, the CEO, or offer, he was really clear. He was saying, look, the business is running well, demand is still there, but the big picture, the really important thing, is how Similarweb is becoming a go-to data provider for the entire AI world. They really see that as their next huge growth engine.
And this is where you really see that split personality of the quarter. On the one hand, you've got some serious green flags. Their RPO, that's remaining performance obligations, basically revenue that's already locked in for the future, is up a whopping 26%. Plus, they're generating free cash flow and even raise their profit guidance. But then you flip it over and you see the red flags, the watch items. Their net revenue retention dropped below 100%. We'll talk more about that in a sec. They didn't raise revenue guidance, and oh yeah, there's a CFO change coming up. So, a lot to unpack there.
So the heart of their whole bull case really comes down to this three-part AI strategy. First, they're building tools for their customers to track what's happening in AI. Second, and this is the big one, they're selling their unique data directly to companies that are training those big AI models. And third, they're putting AI into their own products. That second piece, selling the raw data, that's the massive opportunity they're trying to sell investors on.
Okay, so management is painting this really exciting, forward-looking picture about AI. But the market? The market was focused on the problems right here, right now, and those immediate concerns totally drowned out that long-term story.
And the single biggest concern, the metric that really matters here, is net revenue retention, or NRR. It fell to 98%. Now, for anyone who follows software as a service stocks, you know that anything below 100% is a huge red flag. It basically means you're losing more money from customers who leave or downgrade than you're making from your existing customers who upgrade. It immediately makes you question how much customers really love the product.
Now, to be fair, management had an answer for this. They said, hold on, that 98% number is misleading right now. Their argument is that they've signed these big, one-time deals with AI companies for them to test out the data. Since those aren't recurring contracts yet, they don't help the NRR metric. The big bet here is that once those companies finish their tests, they'll sign long-term deals, and that NRR number will pop right back up.
And you have to look at this in context, right? The stock has been getting hammered all year. It's down big time, while a lot of its cloud peers are actually up. So when you're underperforming that badly, investors just don't have any patience for excuses or jam tomorrow stories about AI. They want to see results, and they want to see them now.
So, that brings us to the big question. You've got management's bullish story on one side and the market's deep skepticism on the other. Where does that leave the stock today, and what are the key things we need to watch for going forward?
I mean, after a drop like this, you have to ask, is this stock a falling knife you should stay away from, or is this actually a chance to buy the dip?
And honestly, the whole investment case right now is balanced on a knife's edge. The bulls are going to scream about that 26% RPO growth, saying, look, the future business is already sold. They'll talk about the huge AI opportunity and the fact that the company is making cash. But the bears, they're just going to point right back at that 98% NRR and say this is a problem. Add in the stock's terrible performance and a new CFO coming in, and you've got a recipe for risk.
So what's our call? Looking ahead, we think you're going to see continued kind of modest growth. Think low double digits. They'll probably keep costs in check, so margins should be fine. But the stock price itself, we think it's going to be pretty volatile, likely stuck in a range. It's all going to trade on news about two things, and only two things. Proof that those AI deals are converting and getting that NRR number back above 100%.
So putting it all together, with that balance of risk and reward, we're kicking off our rating here at Market Perform.
At the end of the day, Similarweb is the definition of a show-me story. The AI strategy makes sense, it's credible, and the potential is definitely there. But potential doesn't pay the bills. The market needs proof. So until the company can show that this cool AI story is actually turning into real recurring revenue growth and that NRR number bounces back, the stock is probably just going to tread water, performing with the market but not beating it.
And of course, a quick reminder, this is not financial advice.